Dear Governor Yuri Matolsky, Governor Novotny, Governor Benoit Cœuré, all recipients of the Lamfalussy Award in the previous years, distinguished governors and colleagues, honorable guests, ladies and gentlemen, I would like first to, of course, pay tribute to the wisdom and the work of Alexander Lamfalussy, and I'm very honored to be receiving in the name of the BIS this year's award. I would like also to pay tribute to the family members that are present at this ceremony. As I mentioned yesterday, while accepting the Lamfalussy Award with great honor on behalf of the Bank for International Settlements, about 40 years ago, when Alexander Lamfalussy came to Basel to work at the BIS, the world economy was changing, moving from a system of fixed exchange rates, capital controls, rigid financial regulations, to a much more open and market-driven system. We were at the beginning of a second phase of the globalization process. And today, the global financial crisis might be producing a comparable regime change with big challenges too. I will address some of them in my remarks, and let me try first to summarize them. The global financial crisis has been challenging us in many analytical and policy dimensions. We achieved significant progress in models that improve our understanding of global financial cycles. We proved that we were able to refashion and use old and new monetary policy tools to affect financial market sentiment. For example, boosting short-term exuberance. We have managed to avoid a 21st century Great Depression. And yet, despite all that, which incidentally is not bad at all, we seem to be stuck in a relatively mediocre low growth, as the governor was mentioning earlier, and a very volatile environment. And the question is why? I think one reason for that might be a lack of confidence, not as a sunspot phenomenon, but in the following more structural sense. I think in some ways, markets still cannot firm up their expectations about what is the post-crisis long-term sustainable growth rate, a reasonable return on savings through investing in safe assets, a sort of a benchmark, and a sensible method for pricing assets and risk-taking. The differences between current competing and yet plausible narratives about the future are simply too big. And thus, markets remain unanchored, held more than ever hostage of the smallest rumor, and hence, as we have seen in the first weeks of this year, highly volatile. So how could we re-anchor markets' faith in the future? Perhaps, as we are beginning to see, one answer could be to signal that there is a roadmap towards a gradual normalization of monetary and financial conditions. But to be fully effective, that requires also being capable of implementing reforms in the real economy. Such so-called structural reforms should lead us to a more sustainable socio-economic contract that in turn should address some of the disputes about current and intergenerational resource allocation, which is what our societies call social contracts. Now, this is naturally, as you can see, much beyond macroeconomics, but our dismal science can perhaps contribute with some useful elements for our societies to choose from. So let me try to provide some of them, and I will start from things that we know well and move up to things that we know less and know perhaps not a great deal about. So let's start first with things that we know well, credit booms and bust. I think we know very well now how credit booms surge and go bust. And as it was remembered here, one of the concerns of Alexander Lamfalussy was about precisely how to control exuberance and financial stability. We started, remember, with the brilliant seminal insights about how asset bubbles emerge and thrive, and the inherent unstable nature of finance. Remember Kinderberger and Hyman Minsky. But now we have developed much more detailed general equilibrium analytical frameworks with all the proper micro foundations, and these frameworks show how shocks on certain asset prices, perhaps housing for instance, can be amplified in an economy with some financial structure, a central bank and a banking system that offer credit to agents with some pricing of risk. Credit booms can be replicated in those models through a number of mechanisms, for example, financial frictions, imperfect information on risk, overvalued collateral, and all this can contribute to excessive credit growth. And this is despite standard anti-inflationary reaction by the monetary authorities. And then lax prudential and regulatory rules is another important element now well recognized in the buildup of financial vulnerabilities. So these models that we know are very useful also to study policy responses and their trade-offs. We know very well that combining textbook policies that dampen aggregate demand, for example, monetary policy, with regulatory and prudential tools can constrain credit multipliers using reserve and capital requirements, provisions, and this is very effective. It can moderate financial cycles and lean against the wind. It is called now macroprudential policy, and as I also said yesterday, it should be remembered that some of the measures first proposed by Alexander Lamfalussy concern precisely financial stability and at the time of a rapid growth of international lending during the second half of the 70s. These measures would be called today precisely macroprudential policy. Now, although the debate is very intense about if, how, and when, and how much of this combination of instruments policymakers can use, ex ante or ex post, to prevent financial excesses, these things have been well examined analytically, and they also have been implemented successfully in advanced and emerging economies alike. Another thing that we know well is how credit booms can be exacerbated through cross-border bank lending. Again, one of the concerns of the work of Alexander Lamfalussy. I'm referring here to surges in euro-dollar bank lending from large to smaller advanced economies, for instance, in the European case. They often bypass existing prudential regulations and contribute to a risk-taking channel of monetary policy, work that has been done at the BIS by my colleagues Yoon and Yoon Chin and Claudio Borio. It happened, for example, in the accession period to the euro. Now, cross-border lending is useful, but it can also contribute to a credit boom. They boost asset prices, they appreciate currencies, and they make sovereign spreads decline perhaps too much. First, this is always perceived as an improvement of macroeconomic fundamentals and of sovereign risk because it strengthens financial stability indicators. And consequently, it leads to even more lending and even more capital flows. Now, we know very well how this story ends when you have at the same time the buildup of financial vulnerabilities. And more recently, as we also know, these surges in international lending has also affected emerging market economies after ultra-easy monetary conditions in core advanced economies created a sort of sudden floods of financing into emerging markets. Very much the same story that was happening at the time of Alexander Lamfalussy at the BIS. We also know that such an external boost to local business cycles can further complicate domestic policy settings by emerging markets, particularly for central banks that face a much more complicated trade-off. Now, if we back to models, the analytics of this is a bit more complicated in an open economy than in a closed economy, but it can still be captured by the instruments that we have, like open economy, dynamic, stochastic general equilibrium frameworks. And we also know very well that globalized financial markets that combine an adequate local monetary policy reaction with macroprudential tools, when you combine these two instruments in an open economy context, things can be very effective to moderate also excessive cross-border credit flows and also to moderate this sense of financial instability and vulnerabilities that emerge. Now, of course, the debate is a bit more heated when it comes to measures that have a little bit more of sensitivity, for example, capital management measures, capital flow management measures, which used to be called capital controls, but this whole environment has been well mastered analytically and in terms of policies by both advanced economies and emerging markets. Now, a second thing that we also know relatively well are macroeconomic policies to achieve external and internal balance. What does the models that I described previously tell us for small open economies? Well, they tell us simple things. In order to avoid the typical emerging market, small economy, debt crisis, policymakers can combine macroprudential instruments, capital flow management, and aggregate demand measures, especially, for instance, monetary policies. And that came, in a certain sense, to the rescue of a more old-fashioned workhorse model used for a long time by policymakers, the famous Mundell-Fleming framework. So ironically, the crisis put advanced economies and emerging markets in equal footing, and it validated standard models and recommendations for macroeconomic and especially financial prudence. Now, of course, before the crisis, you had several useful refinements that had been added to complete our understanding of how to avoid the crisis. Elegant models of exchange rate crisis, remember Krugman, Obstfeld, lots of theoretical and practical work confirming the effectiveness of conducting monetary policy using inflation targeting framework, and so on and so forth. Central banks improved their track record, anchoring inflation and expectations at low and stable levels, combining interest rate policies with increasingly sophisticated communication. And therefore, many countries adopted what is now the current dominant macroeconomic policy framework, a relatively floating exchange rate regime, a relatively sustainable fiscal policy, and a relatively open capital account, which in turn ensures room for maneuver for a relatively independent monetary policy. Finally, financial stability goals and instruments, supervision, further complemented the framework. So, in a sense, we knew very well how credit booms emerge and how to reach internal and external stability. provided the local political economy setup did not interfere too much with the triple constraints embedded in the Mundell-Fleming view of the world, policies can and should remain consistent, and when they combine exchange rate flexibility, domestic demand management with a moderate debt level, that can limit the likelihood of crisis. So we learned a lot in these years about how to cope with what is called the impossible trinity, with large capital flows, with financial cycles, and how to design a set of robust policies to ensure both internal and external balance. So, in a sense, facing the same problems that Alexander Lamfalussy had to face decades ago, it appeared that now we had more answers and more instruments. Now, is it true? Well, it's always a little bit more complicated. So let me move to the third point of my remarks here. Spillovers and collateral effects. So we know relatively well that spillovers might make these crisis prevention policies and instruments that I just described a bit more complicated. I think we are beginning to understand that global financial cycles and the risk-taking channel derail the normal workings of the old self-stabilizing mechanism in the Mundell-Fleming framework. Normally, in the Mundell-Fleming world, the exchange rate acts as a stabilizing variable when it affects relatively quickly the real economy through exports or imports, adding or subtracting demand impulse given its price elasticity. However, the risk-taking channel creates a different type of dynamic because of stock accumulation of liabilities in international currencies. And these stocks might be not completely related to the needs of the real economy, the local real economy. And what happens is that, therefore, balance sheet risks accumulate in good times through excessive foreign currency borrowing by firms and households. So first, things look all right. The observed exchange rate volatility is low. The risks of excessive debt and foreign exchange mismatches are downplayed. And moreover, as we know, when you have exchange rate appreciation and other assets prices appreciating in your country, and when it begins, the local political economy cycle usually contributes to reinforce credit booms because you have wealth effects, you have expectations, you have policy complacency, you have a sort of exuberance and euphoria that takes over. And everything is interpreted favorably. You have simplistic arguments. Well, the exchange rate appreciation is useful. It's usually a misreading of the Balassa-Samuelson effect, but it's sometimes endorsed even by very sophisticated analysts. You have a benign neglect that, of course, holds until there is an exchange rate move. And when this happens, because the vulnerabilities have accumulated in the balance sheets of the corporate and the banking sector and sometimes the household sector, then the adjustment is too quick and it doesn't really produce the adjustment, the smooth adjustment in the real economy that is desired. On the contrary, it often increases risk premium and inevitably undermines the confidence on the country's financial stability. So it's a little bit of a paradox here. We know better credit booms. We know that they are dangerous. And we also know that our political economy inevitably seems to be procyclical. So why is it that we allow this to continue? Is it because, for instance, that we know a little bit better how to control these financial cycles, ups and downs? Well, let me now, my fourth point. In a sense, well, yes, we know relatively well how to use old and new monetary policy instruments to boost financial conditions and market sentiment. Remember, just after the GFC, old conventional macro policy worked very well to help stabilize financial conditions. The cost of money fell quickly as the policy rate was brought to its zero lower bound. Liquidity was provided in time and quantity to unfreeze interbank markets. But after a while, though, additional and what was then coined as unconventional monetary policy, UMP, were implemented. And balance sheet policies were used, sometimes labeled quantitative easing. These policies, of course, boosted asset prices and financial conditions beyond the effect of the already ultra-low short-term policy rates. Although these policies are not necessarily unconventional, for instance, remember in the old times, Forex intervention had used balance sheets of central banks. It was their size, their intensity, and their persistence that was new. The central bank's balance sheet was used to improve the risk profile and composition of private sector balance sheets, in a sense bypassing the fear and market risk aversion and purchasing less liquid or even risky assets. And you remember another important element of UMP was a very strong communication strategy of forward guidance to influence expectations and put downward pressure on the term premium. So all this worked as it should at the beginning of the crisis. And both policies helped to stabilize financial conditions and reduce what was at that time a predictable, very large contraction in aggregate demand. Conventional and unconventional policies were adopted by major central banks and certainly helped to unfreeze markets. However, 9 years into the crisis, they perhaps seem to be producing diminishing returns and at the same time some market addiction. In other words, we seem to be at a sort of a critical juncture point where the divergent path of monetary policy conditions between the dollar on the one hand and the euro-yen zones on the other hand is happening, but still we don't have a return to the old normal before the crisis. And remember that the assumption, I think, underlying UMP, these exceptional policies, was that at some point in time, after keeping the cost of money low for a prolonged and predictable period of time and flattened the term premium, making long-term financing costs also exceptionally low, there will be a rebound in confidence and risk-taking. So these conditions appear to be emerging in some areas, but not necessarily in the global economy as a whole. Now, why? Now, let me then come to my fifth point, perhaps because it is of animal spirits and confidence, or lack of confidence. And let me admit here, let's admit that we know much less why the post-crisis recovery has been relatively weak and uneven after these unprecedented policy stimuli. The current recovery, for instance, has been labeled a new mediocre. And there are several competing narratives that try to explain why this is so for advanced economies and emerging markets. And these explanations range from, well, first, it's purely cyclical. It's a simple conjunctural issue of deleveraging to pre-crisis level. After that, normal growth will come back after everybody pays debts. Or you have a second explanation that is a little bit more sort of negative, saying, look, it's structural. We have a new pattern of long-term growth. And we have explanations for that in advanced economies, the secular stagnation hypothesis, or in emerging markets with the middle-income growth trap hypothesis. I mean, in short, there could be forces at play now, revealed or exacerbated by the crisis. Think, for example, of deleveraging plus fear plus demography that produce higher savings, more inequality. These forces are all pushing the real neutral rate of interest far below what it was. So even with all the existing stimuli, and even adding more of it, as some are advocating, aggregate demand would remain subdued. Now, under these various narratives, there is a huge differences in the new post-crisis sustainable growth path for emerging markets and advanced economies. The current slowdown might be simply a sort of a convergence to the mean after many years of exceptionally high growth, but it could also be a much deeper secular stagnation story. And then, coming back to my point, perhaps this is the bottom line. Think of, let's say, the animal spirits of entrepreneurs in the real economy, remembering Akerlof and Schiller, in the sense of the capacity to make longer-term investment decisions. I think these animal spirits are still numbed. It's a lack of confidence. They are confronted with several different stories about what is the sustainable long-term growth, and they cannot form a definitive view. In this sort of blurred environment, market sentiment fluctuates, and they follow ups and downs. They are hostages of the hints, expectations, if there is another injection of QE. And therefore, of course, financial markets may overshoot. But the problem is that real economy investors, they would prefer, given this differences in the future that they see, to wait and see. And of course, then the economy and the expectations for long-term growth remain anchored and not capable of identifying a sort of a bottom line for the GFC. So in this context, it is difficult for the real economy. What is the sort of the consensus for sustainable long-term growth? What is the non-accelerating inflation rate, not accelerating inflation rate for unemployment? What is the slope of the what is called the new Keynesian-Phillips curve? What is the post-crisis neutral interest rates? And in less technical terms, I think the difference between equally plausible narratives for the future is simply too big, and it is difficult to invest and take risk under this sort of structural uncertainty. Now, what can we do? Is then a way to reestablish confidence in the future. My sixth point, we get here into much more complicated and uncharted territory. I think we know very little about the relation between what economists term confidence and social stability to contractual social political arrangements. Confidence in the sense of positive animal spirits imply, inter alia, some durable view about the future. And the Great Moderation was quite possibly such a moment where you had all these parameters, these technical parameters for investment decisions and confidence allied and deemed consistent. But confidence results also from a complex set of economic and non-economic variables. One important component of it is stable rules And institutions and the binding arrangements on agents' behavior. Remember this work on institutional economics, Acemoglu, Robinson. Beyond economic rules, confidence has to be constructed by establishing and upholding viable, sustainable social-political contracts. Remember the work of sociologists, people like Francis Fukuyama. These contracts should define rights and responsibilities in maintaining order and discipline in primitive societies, but in market economies, they have to evolve towards rules to keep low debt, low inflation, and productive and cooperative, efficient arrangements. We economists try to summarize this, all this in terms of the viewpoint of institution stability, credibility of policies. But it boils down to these arrangements that are perceived stable for investors. Now, when you don't have that, or when these arrangements are disrupted, macroeconomic management becomes much more difficult. Perhaps the GFC has produced such a disruption. We have progressively through our history elaborated in both advanced economies and in emerging markets these sets of rules to erect a more or less socially inclusive and protective state. However, these rules appear now increasingly incompatible with our capacity to finance their tax implications and the fair distribution of their benefits. In other words, if you remember the beginning of what I was alluding to, we have not necessarily earned what we thought was our welfare state, building its financing on a permanent, sustainable based growth. We have probably borrowed our modern welfare state, and now this debt that we have contracted is coming back to haunt us and, of course, to be repaid. And yes, then we witness these tensions about budgetary allocations in our modern societies, social security, pension systems, that are all part of the painfully gained social-political equilibrium in the pre-crisis welfare state. The crisis has perhaps revealed that these rules have to be rethought. And of course, when there is this uncertainty, it increases risk premium on debt, and markets reflect that. Remember, for instance, the tense debates on burden sharing about debt servicing in the 2010-2011. It's common in both advanced economies and emerging markets. So when you have this difficulty in defining the new contours of the arrangements that would allow financial stability, budgetary stability, sustainable public finance, then of course you have a failure of getting a consensus about present and intergenerational fairness. And not having these instruments anymore makes then, at that point, I think it translated into having monetary policy as the only game in town to try to solve these problems and to support the recovery. And all this, unfortunately, is not an environment favorable for confidence. I think our dismal science with its macroeconomic and financial policies cannot address all these issues that are much beyond our discipline. But nevertheless, economists need to raise awareness and alert that our societies, we can live for a while with this sentiment of uncertainty and gloom, but not for too long. We have to reflect on what exactly are we signaling for the future policy directions. Are we not ourselves contributing to create expectations that precisely go into the direction of the secular stagnation scenario? We are maybe reiterating that mediocre recovery always need additional stimulus, and that simply reinforces the perception that negative rates, for instance, will remain here for a long time. Now, what if this perception starts to affect the savings behavior and the balance sheets of large holders of long-term assets such as insurance and pension funds? I don't think we need to fall in the opposite, which is a sort of a naive, optimistic incantation about a bright future. This is, of course, futile. But, and recognizing that there are no simple answers to these questions, we need to reflect on the way we are sort of showing the future for our entrepreneurs. So let me conclude. We have managed to better understand the global financial cycles. We know how to manage them. We have instruments. But I think we need to understand and ask ourselves if our capacity to reinstate growth rests only in using financial markets and hyperinflating some new type of asset class, whether it is emerging markets, housing, bonds. Can we think of an alternative? Animal spirits might be subdued despite the unprecedented monetary stimuli because of the absence of a clearer picture about long-term sustainable growth and its related parameters. Therefore, shouldn't we focus on maybe this, more sustainable growth through reforms, through real economy-based productivity? We know that some technology components of this perhaps new business cycle are apparently already in our daily life. For example, there is very low marginal cost for some activities. We have faster communication. We have new internet-based services. We have new exchange rules, new technologies that we all know. It is not, of course, for central banks to directly engineer policies to foster more productivity, but neither can central banks just bet on another credit boom and bust cycle, even if we know much better how to control them. So we should perhaps be pressing a little bit more, everybody, to focus on the traditional financing role for the real economy that contributes to long-term productivity-based growth. And can our dismal science participate into this process? Well, I think sure, perhaps bringing precisely some of these discussions and elements to re-anchor markets' expectations in the future. We shouldn't be, of course, naive either. This is, of course, not a straightforward issue. You have many new technologies that will change relative prices, including that of capital, and that might have an ambiguous, if not a negative, impact on other factor markets, precisely such as labor. There will be transition cost. I think still it is possible to at least begin discussing a route towards a new growth pattern with its associated new social contract. Some of this is happening with the current normalization of monetary policy in the United States. Some of this is coming, I think, with systemic countries that are redefining their growth model and social contracts in many countries. I think at the end, confidence will return in a durable way only when agents perceive that we have passed the bottom of the GFC. And of course, we all hope that this will be the case in the coming years, in the coming months, with the efforts that the Europeans are putting into this and through the numerous discussions that we can see. So let me finish reverting back to Alexander Lamfalussy. Remember his essay on financial crisis in emerging markets? He anticipated the increased risks faced by the global financial system. And I quote him, "However significant its contribution to efficiency gain the process of globalization makes our financial world more, rather than less, risky place to live. He stressed the importance of international coordination, and for that reason, and I quote him again, he said, governments, central banks, and regulatory agencies will have to meet the greatest of all challenges, setting up a well-structured and efficient cooperative framework at the global level. Among the many changes that I pointed out here to you, and again paying tribute to the memory and the wisdom of Alexander Lamfalussy, these are challenges that still faces us today. I thank you very much for your attention.